Now, technical analysis is it's a funny thing. Some people call it an art. Some believe it's a science. But really, it's making art out of a science. Anyway, I'm being funny here. I'm rambling. But what is the benefit of technical analysis? Technical analysis allows you to look at quantitative data to inform you as to the trend or what may be going on with an asset and its price value. So what we have pulled up here is the Bitcoin chart. And you can see there's a whole lot of stuff happening. We got lines, we got candles, we have zones, we got moving averages, we got RSI, MACD, volume, we have all this stuff. And the fact of the matter is, you don't need it all. Sometimes less is more. We'll get into that. But the things that are going to be your key indicators. So let me walk through this and let's hide a lot of this stuff and let's bring it back in gradually so we can demonstrate this point. Give me 1 second here. Boom. Okay, so what we see now is a much more stripped down version of this chart. Okay, so we're going to go ahead, move these two down as well. And now what we're looking at is simply the price. And the reason we do this is because anytime you're pulling up your technical analysis, now also, disclaimer, there are people who are marvelous with these charts and you can do a lot with them, but don't feel that it is the end all be all of being a good investor or even a good trader, because sometimes less truly is more. Now, we're going to work through these one by one. The first thing that you're really going to want to do when you're establishing TA is you want to look for your most important levels. So when we say support and resistance, this is basically where price finds support and then where it has a hard time getting above. So, for instance, let's go ahead and say that right here, we find that we keep wicking down. So we see you have these candle bodies, which are the solid color, and then the thin line, that's known as a wick. Now, a wick simply demonstrates the history of where price has occurred. So there's been a sell or a buy. If there's a sell, there is a buy, technically, right? But you see where the price has traversed, but the candle body shows you where the bulk of the trading action actually took place. So wicks are kind of like, they're outliers if you want to look at it that way. And then the bodies are more so the that 68%, if you want to call it that, of the bell curve distribution, if you will. So what we can see here, we'll zoom in just a touch, is that we had continuous touches. We had a wick here, we had a wick here, a wick here, and then really, we could really move this line up right there, and we see that every time the price came down here, it received support. And then if we jump here in the future, this was in January, we're back here in May, boom, we're finding support there once more. So this is what we would call a support line. So let's go ahead, and I'm gonna change this, and we're gonna make this blue for support. Now, the other little tidbit, some people, they would say don't ever use a line to create a support or resistance zone, but instead use a zone, all right? So what you'd want to do in that case is you'd want to create yourself a bit of a spread, because it acknowledges that that support and resistance could occur inside of many different specific levels, because as you zoom in closer and closer down on the 4 hour, on the 1 hour, on the 30-minute, 10, 15-minute time frames, it starts to look a lot different. You have a lot more candles that are going to hit different areas, so it can be helpful to do that. So we'll do both to get you in that rhythm. So now let's do the opposite. Let's look for an area where the price had a hard time going above it. So as we can see, we came up here, we were rejected. And then we had some more history where we came up, touched it, and were rejected. So for the time being, we're going to go ahead and we're going to put a resistance line in this area, more or less. And then we're going to turn this and we're going to make it red. And then we're going to do the same thing. We're going to draw our zone, because truthfully, there's a little bit of a zone here, just like the support level. And we're going to do the same thing, make this red. And what you can also find interesting is that a lot of times your previous resistance levels become new support levels. So if we look at the price action and how it came back down and then it bounces and then it gets close and it bounces before it even touches. and then it bounces in this area too, and then when it falls through, it really falls through, and now it's resistance once again on the backside. So this is, if nothing else, one of the first things to do when you're setting up your technical analysis, because it's going to put you in a better position to, without the rest of the things that can start to kind of make a chart really busy and almost overwhelming to look at. It shows you, okay, it's going to be tough for us to fall beneath 30K, and it's going to be hard for us to get above 40K. And wouldn't you know it, that's the range we've been playing in. It was a range we had back in December and January, and it's a range we're experiencing now, okay? So then what you want to do after that is you want to pull in some moving averages. So we're going to pull in, what we have right here is the 10 EMA, and we'll reveal it, and you can see that when we're trending up, it acts as support. When we fall beneath it, it acts as resistance. We get above it, it's support. We have bullish action. We fall beneath it, it gets bearish. We get above it, support. We get beneath it, bearish. And you can see these flips and these turns. And then we've been beneath it since about the 12th of May. And for people who are really on their TA, and this is one of those moments where I was like, doggone it, had I been more on the charts, maybe could have capitalized on this move. But once it dropped beneath it with a strong candle, boom, it's been bearish ever since, and we're still beneath it, right? So that's an EMA, exponential moving average, and this is the 10 EMA. So if you wanted to make it 21 or 100, all you would do in TradingView is you would come in, you go to inputs, and then you would change it. So this is a 10 currently. If we were to move it to 21, boom, hit OK, it's going to show us a little bit different of a picture, okay? But it's still very similar, and you can see it always at some point likes to, if it gets overextended, it comes back and it touches it. And when it touches it, that's when it's going to test to see if we can get back above it. And so we've touched it, and we're going to have to see if we can get back above it or not. But obviously we've drifted from it to some degree. So that's the EMA. Then one of the next things you could bring in would be a Bollinger Band. And so what a Bollinger Band is really going to do is it's going to demonstrate a measure of volatility. So the tighter the band gets when it gets constricted, what this is showing you is that volatility is leveling out. There's a decrease in volatility. And then when it widens itself up, the volatility has increased once more. And so as you can see, when you hit the top of this range, the price tends to come back down. When you hit the bottom, it tends to go back up. And then the range obviously moves around as well, but that's a Bollinger Band. Okay, and then we can look at the MACD. I'm sorry, the relative strength index, the RSI, is what's next on here, and that's what we have down here. So let's go ahead and can I flip this? Anyhow, we'll leave it right here. And so what you have on the RSI is you're looking at what is basically a range between about 30 and 70. Now, obviously, the range is greater than that, but this purple area that is shaded, this is the normal range, quote unquote, of the RSI, the relative strength index. And what this is aiming to demonstrate is whether an asset is oversold or overbought. So if it's oversold, it's going to be down at the bottom of this range, and typically it's going to dip beneath 30. And if that's the case, what likely happens after, even when it touches it, is a bounce. And so as you can see with this dotted line vertically, we hit the bottom of this range, and then we bounced up a bit. Just like when we get too high, we tend to calm down, level off, and come down a bit. And so oversold is anything beneath 30, typically, and then overbought is anything above 70. So this is what the RSI tells us. And then we have the MACD, which we threw up above. So we'll go ahead and throw this down at the bottom, and then we're going to throw the RSI up top. Get that out of the way a little bit. And then we're going to take a look at this MACD. This is a measurement of trend reversals. It's a momentum measurement technically, but it can give a hint as to what the momentum is going to change. So as you may have guessed, when it turns green, that is an indication that the momentum is turned bullish. When it goes red, the momentum is now turned bearish. And so you can assess these in a couple of different ways. You want to look at how long it remained on one side or the other. So if there are more green candles, then that was a longer trend. If there are more red candles, that's a longer downtrend. And the other thing you want to inspect is the actual amplitude of the candles themselves. So as you see here, we'll get it down to this area over here. when we look at the actual amplitude or the magnitude of these candles, it's measuring a negative 1600 roughly. And if we go up and we look at the green, it's measuring at only a positive 700. So this has a greater magnitude of its negative or its bearish momentum reversal than it does on its bullish reversal in the short term. And we can see that because we're in a much stronger interim downtrend, and we have not yet definitively broken above that at all. So that's one way you can inspect the MACD. Now, after that, we have the Fibonacci retracement. So let me try to give you a clean example here. And basically, the Fibonacci retracements it's some mathematics done based on the Fibonacci sequence of numbers, but all it really is serving to do is to demonstrate where you could see some price retracements and then where could those targets be to the upside. So the way that you do it, really rough, quick explanation, is you take a impulse move, so we'll call it right here, and then you see how we were kind of consolidating, and then all of a sudden we popped up, and then you take it to the height or the apex of that move itself. So let me get out here. Boom, we'll say that was about the apex, right around here at roughly, let's call it 41,700. So what we can see now, and then it's funny because I'll actually need to go in and hide some of these things to make it a little bit easier to see. Where do we have this? Bollinger Bands, let's hide that. And then let's hide the EMA. Excellent. Okay, we'll move this back down to the bottom. Let's make that a little smaller. Pull this in. Excellent. Now it's a little bit easier to see. And so what we're looking at, and we'll go ahead and hide that as well. So now what we can see is you have these different levels. You have one, which is where we started the impulse move. You have the 0.764, the 0.618, the 0.5, 0.38, 0.236, 0, 0.25, and 0.068 to the upside. All right. And these are all different levels and they mean different things. That's a little bit beyond the scope of this particular video, but they're basically likelihoods of the price retracing in that direction. And what people will often look at is what they call the golden zone or the golden ratio. And the golden ratio being this pocket between the 0.618 and the 0.5. Okay. So what that usually means is that on that impulse, you could see the price come back down inside of that range. So even if we look at where the support level was that we established earlier on, we're looking at this price. It ran up from down at roughly 19,343, and it ran up to about 42,000. Okay. And then when it retraced, it came back down to this 0.5. And the 0.5 is a big area inside of the Fibonacci retracements that people often look for their first take profit level if they're going to short, or their first entry level. And so what we can see there is that it came down, it wicked really hard, and it hit the 0.5 level almost exactly, and then it came back up. And then there was a candle body that damn near closed beneath it. And depending on how we drew this, it'll change where these levels are slightly, but just look at this confluence. So we have the support level, and we came back, we tested it once, we tested it twice, and then we tested it 3 times, 4, 5, 6, 7, and then it took off, right? And when it took off, it ran up and it hit the 0.236, it hit the 0 level, it hit the 0.25, and it hit the 0.618. It did all of those, okay? And so, as I said, you can go down a rabbit hole there. You can feasibly create a profitable, a beneficial trading strategy that's centered entirely around Fibonacci retracements. Many, many people do. But as I said, if you want to know a little bit more about that, then you'll just have to take some time and dive a little bit deeper separately on this alone. But there is much, and I would encourage you to do that for sure. All right, so we'll go ahead and get this level out of the way. And then let's go ahead and let's look at the volume. So we'll go ahead and reveal the volume once more. We can find it. Goodness gracious, where'd the volume go? Boom, okay, here we go. All right, so Volume is basically exactly what it sounds like. It's telling you what was the density of trade, right? Were there a lot of trades being made? Were there not a lot of trades? So this candle right here represents a lot of trade volume, right? There was a lot of trading happening at this particular level where this candle is, right? But if we look at the color of it, this was a lot of selling volume. The majority of this volume came from selling. The majority of the volume here came from buying, right? So green is selling, red is buying. You can change those colors to suit you, but that's basically what they're representing. And similarly to the MACD, you want to look at the amplitude or the magnitude of these candles. The greater the candles or the taller they are, that's showing you greater volume. The lower it is, that's less volume. Now, quick little thing we'll cover right here is this idea of hidden divergence. Okay, so what we want to look at is, let's come in and let's do it. Let's zoom in a bit. And if we see for these last couple days, let's go ahead. We have this, what was a downtrend. All right. We saw a downtrend in the price. And then we saw underneath it, we saw an increase, albeit slight, in the volume itself. Okay. And so, oopsie daisies. You can look and find these different patterns based on if you see whether it's the price action or the RSI doing one thing, and then if you see the volume or another indicator doing the opposite, that can show you what they call hidden divergences. And you have hidden bullish and you have hidden bearish divergences, which all will tell you different things. But it's just something to keep in mind, and it's one of the reasons why sometimes people like to have more indicators so they can create more of that information for themselves. So then we have, after the volume, we have the Bitcoin dominance. Okay, so let's go ahead and let's pull up, let's go to CoinGecko. And then what we're going to see here is we're going to be able to look at what we can look as you see here, we have total market cap. So this is the entire market cap, as far as CoinGecko is tracking it, of all of the cryptocurrency specs. And then we have the dominance level. And so as you see right here, it says BTC 42.9, roughly 43, and then ETH 17.3. What this is saying is that out of this entire market cap, Bitcoin is about 43% of this entire number. So Bitcoin's market cap currently is about $692 billion. That is roughly 43% of all of the market cap of the cryptocurrency industry. And then Ethereum, its market cap, which is about 280 billion at this moment, is roughly 17% of that entire market cap. And the reason that's important is, long story short, when Bitcoin is doing well, its dominance increases. Why? Because its market cap is going up and it's eating up more of that overall market cap of the cryptocurrency space. But when Bitcoin dominance falls, it's typically a sign that the Bitcoin price is either weakening or that, relatively speaking, the accrual of price action, the positive price action to the upside, is greater for all of the other coins that are not Bitcoin related. So when there's an alt season, one thing that people look for is for a significant drop in the Bitcoin dominance, because that usually is a signal that that dominance is going elsewhere to other parts of the ecosystem. So that's something to watch for and keep in mind. And there is a way for you to go inside of TradingView and pull that up separately. It's its own chart. I don't have it up right at this moment, but you could do that if you wanted to. And then you have the fear and greed index and the liquidation ratio. Now, if you've, I would highly recommend you really take a separate note for these two things, the fear and greed index and the liquidation ratio. Now, this is stunning. Now, let's go ahead and reload this. But basically what this measures, and it goes into some detail on how they get this information, but it's a representation of the fear and the greed in the market. And as I'm sure you've heard many, many times, you know, be greedy when others are fearful, but be fearful when others are greedy. And you can see that last month, the greed was quite high. It was at a 68. It was way up here. And then we dropped this low and we didn't end the weeks, but this fear index was at like a 13 a few days ago. It was pretty low. And so you can look at a historical context. You can look at the all-time fear and greed. You can look at it over the past year, right? And you can see that we're at all-time lows for the past year, right? So what would that tell somebody? If we're at an all-time low, well, basically, or a low for the last year, that shows how far we have corrected in the market sentiment. There was extreme greed, there was overzealousness, there was mania, as they say in that good old, Wall Street psychology cheat sheet. And so one could presume that if we were to take this information, and then if we were to look at what we have going on a larger trend or this multi-month trend in terms of support and resistance, that sure, we have a fight up here and we've lost it a couple times, but one could say that we are nearing the bottom of the range, right? People have different numbers. Some people think it's 20K or so. Some people think it might be up here around 24. And then there's some other data ones could go off of, but it gives you a really good idea of where the sentiment is. And there's still a lot of fear, right? When there's fear, typically, no matter if it's the bottom or not, it's a really good time to be buying. Whereas when we're at 68s and higher, 91s, these high levels, that's typically a good time to be taking some profits. Now, after that, we have the liquidation ratio. So let me go ahead and refresh this page. Okay. Now, what you will find quite interesting if you follow this over time is that it tends to oscillate back and forth. And it usually goes up to about 85 or 90%, where what this basically is demonstrating to us is the ratio of liquidations happening through derivatives. So what this tells us at this moment is that in the last 24 hours, I believe this is what this is measuring, 24-hour volume, about 58% of all liquidations have come from people who were going long. So people who thought the news from El Salvador or whatever else is going on, if they thought that was going to be a very bullish catalyst, they went long. They're like, okay, the bottom's in, time to go long. Well, 58% of all liquidations were long positions being liquidated. And on the opposite of that, about 42%, the remainder, were shorts being liquidated. Now, what we're seeing is that these two are balancing out a little bit. And what you'll notice over time is that as this ticks up, because earlier today, this was at 50%. So this usually ratchets up to about, as I said, 80 or 90%. And then you'll see it swing the other way. So what we could say then is that the price may continue to drop a little bit further until we reach about an 80 or 90% liquidation ratio of longs, because at that point, a lot of the money has been made from these exchanges liquidating the longs. And then at that point, it will begin to decrease, and we would see people, because if longs keep getting liquidated, the natural reaction from a trader is, okay, it's time to go short. But at that point, it might be too late to begin shorting it. And then the price actually starts to go up, because if this is at 90, that means the short liquidation is at 10%. So the majority of people are long, not short. And so what's the market like to do? Make the most money possible. So then if it's already liquidated most of the people who are going long, it's now going to target the shorts and say, okay, let's start to liquidate the short positions and get that ratio to about 80, 90%. Let the long folks breathe, because the price actually is going up, but we had all these people who are shorting it. So anyhow, watch this and you might be stunned at just how closely the price action relates to these measurements, and this can serve as a good momentum oscillator, a trend reversal oscillator, just like the MACD and the RSI. And then it'll show you a breakdown per these exchanges that are reporting their data. So that covers the bulk of the kind of baseline fundamental technical analysis that we're going to cover for purely price action. And what that brings us to is the on-chain data here in a moment. And before we get there, a reminder once again, you want to look for confluences. Confluences are really the only reason to have all these other things happening on a chart. So you start, as we talked about, with the fundamentals. You start with support and resistance levels. And after you have that, you can go ahead and maybe you want to bring in some moving averages. So we'll bring in a 21 EMA. Well, we're below prior resistance. And we're below the 21 EMA, and that EMA is beneath the resistance level, so we can see where these wicks have taken place. We're probably not even going to go back up and retest this resistance, which means we're probably going to head down a bit, right? And then after that, we bring in the Bollinger Bands just so we can see what's going on with the volatility. The volatility is tightening, and so as this range gets too tight, we're almost near the top of it. It can break to the downside for us to touch at least the bottom of the range, and if the bottom of the range opens up but we don't see any bending downwards, we can see the price move down to try to find the bottom of this range. And then you bring in the RSI, and we're saying, okay, we're climbing, and so far, this level of about 44 has been a support, and so if we don't get above it, it's probably likely going to be a resistance level for the RSI, at least in the short term. And then, if you follow my point, you just begin to bring in these different indicators so we can give you a more complete demonstration of what is happening from a price action standpoint, but you do not need to overly complicate it. Okay, so less is more because it's going to help you avoid analysis paralysis. It'll minimize the amount of false signals that you get, and it will discourage the potential propensity to overtrade.